Welcome to This Explainer. I am absolutely thrilled to have you here today because we are going to completely dismantle one of the most expensive myths in all of investing. Seriously, if you've ever felt like you're just perpetually one step behind the market, or if you've watched the news and wondered, how on earth are stocks going up when the world seems to be falling apart? Well, this is exactly what you need to hear.
We hear this advice all the time, right? Wait for the economy to recover before you invest in stocks. It sounds like total common sense. It feels safe, but relying on this incredibly common misconception is exactly what costs retail investors their absolute biggest potential gains. By the time an official economic recovery is actually announced to the public, the greatest opportunity for profit, it's already completely vanished.
And here's why that happens. Think about everyday economic news, your gross domestic product reports, employment numbers, corporate earnings. All of that data is essentially a rearview mirror. It is only describing what has already happened. But the stock market? It's more like a crystal ball. It is constantly pricing in what is coming next, typically looking a full 6 to 12 months ahead into the future.
Okay, Section 1. The train. Market versus the economy.
Let's dive into this with a mental model that will honestly permanently separate the stock market from the broader economy in your mind. I want you to imagine the entire financial system as a massive train. The stock market is the lead locomotive. It's that powerful engine up front that always moves first and pulls everything else forward. Behind it are the carriages. Those represent the real economy, your GDP growth, your employment data, consumer spending. Because those carriages are delayed by 6 to 12 months, they are agonizingly slow. By the time those clunky economic carriages finally catch up to the exact spot where the locomotive was, that locomotive is already miles and miles ahead down the track.
And listen, this isn't just some neat theory. It is backed by hard, undeniable data. Let's look back at the financial crisis. The S&P 500 hit its absolute bear market bottom in March of 2009. But the U.S. economy, it didn't officially exit the recession until June, 3 full months later. If you were sitting on the sidelines just waiting for economists to confirm that the coast was clear, you missed out massively. The market was already up 30% before the recession was even officially declared over.
Need a more recent extreme example? Look at the 2020 COVID crash. The S&P bottomed out on March 23rd. Throughout April and May, the real economy was in a deep, historic freeze, with massive lockdowns and skyrocketing unemployment. Yet, by June, the stock market had already recovered 40%. The locomotive was aggressively speeding ahead, while the economic carriages were still completely stalled out on the tracks.
Moving right along. Section 2. Government tools move markets.
So this brings us to a fascinating question. If current economic reality isn't what moves the stock market, what actually does? What's shoveling coal into that locomotive? Well, the answer is central banks and the government tools they wield. There are 4 major monetary levers that dictate market direction. Interest rate cuts, which typically make stocks rise. Interest rate hikes, which cause stocks to fall. Quantitative easing, or QE, which is basically rocket fuel. And finally, quantitative tightening, or QT, which puts heavy downward pressure on everything. Let's break these down.
First up, let's directly contrast interest rates. When central banks execute rate cuts, they are making borrowing much cheaper. Companies invest more, consumers spend more, and stock markets typically surge, especially growth stocks. Historically, this is the single most bullish signal a central bank can ever send. On the flip side, rate hikes do the exact opposite. Borrowing costs rise, economic growth is deliberately slammed, hitting the brakes, and money flows straight out of the stock market and into safer bonds and savings accounts.
Next, we have the heavy artillery, quantitative easing versus quantitative tightening. Think of these in terms of the basic plumbing of the financial system. With QE, the central bank is literally creating new money and injecting cash directly into the system by buying bonds. This immense pressure forces investors out of low-yielding cash and into riskier assets, like equities. QT is the exact reverse. The central bank drains that liquidity right out of the system, slowing markets down and potentially triggering significant market corrections if they drain it too fast.
What is truly undeniable here is the sheer power of quantitative easing. It is literal rocket fuel for stock markets. When a central bank commits to QE, they are essentially putting a massive, impenetrable safety net under asset prices. You just cannot fight that kind of liquidity injection. It dictates the mega market trend regardless of what the underlying economic news might be screaming on television.
All right, Section 3, the central bank pivot.
So how do we actually build an actionable playbook to navigate these cycles without getting swept up in the noise? First, make a rule to completely ignore lagging economic news. Instead, monitor central bank meeting calendars. You are watching for one specific crucial shift, the exact moment they signal a pivot from tightening to easing, from rate hikes to rate cuts. Especially after a long period of aggressive tightening, acting on that pivot is historically one of the most powerful and reliable buy signals available to any investor.
And here is the ultimate punchline. Why do we obsess over this pivot? 20 to 30%. When you catch that shift, historical data shows that markets typically rally 20 to 30% in the 12 months following that very first rate cut. That is a massive amount of upside that you will completely miss out on if you're just sitting on the sidelines waiting for the unemployment rate to look perfect.
To wrap up this explainer, I really want to leave you with a challenge. Stop waiting for perfect economic certainty, because in the stock market, certainty is an illusion that is only going to cost you money. You know exactly how the locomotive works now. You know what fuels it. So look at the tools, look at the data, and ask yourself, what is the central bank signaling right now?